All right. I'm gonna go over a turning point, all right, and explain basically the anatomy of a turning point. All right. So this you could call it like the anatomy of a pivot or anatomy of a turn or whatever, but this is how markets turn, whether it's turn of on a trend or turn of a swing. So the what I'm going to be taking a look at is right here. This is a turn, right? Because you have red and then you have a green. So this turn is what I'm going to be looking at. Before going further, I want to make a point clear is that you don't just take random turns and say, "Oh, I want to look at this, I want to look at that." Everything depends on two things, which are the top two things. One, trend, two, level. Reason why I'm looking at this is A, it took out this high, this level, and B, it's extremely close to this. What happened was this market was bearish, meaning there were sellers right here. This is a copper market, by the way. There were sellers here. They didn't realize what was setting up here. This, it looks like a gun, right, with a barrel and a handle. What this is a springboard. This is springboard. It's also like some type of hinge in classical Wyckoff, but it's a springboard. It looks like a springboard. This is the board, and bang. The key is what this means is that this is the end of accumulation. There's certain key types of behaviors that identify the end of accumulation or distribution. One of them is this type of up, down, up, down, up, down, tight range. Up, down, up, down, up, down, up, down. It's like a very tight range. It's like the ending of one chapter and the beginning of another. This is the ending. Right? Anyway, so now it comes to a resistance area, and these sellers, they try to sell against this low risk turning point area. That's why you have the wick, because they tried to sell against that area and it went down. But buyers just had a springboard. They are very interested at these prices, and they overcame that selling, and that is why you have a lot of volume here. Look at this big black, I don't know why it's not green, but anyway, it's big volume right here. This is the biggest volume in about 24 and the biggest volume in about 28 up bricks. Right at that resistance level where sellers tried to sell it and failed, and buyers came in and took the market right back up to the top of the brick with heavy volume. So this is a area you want to see because it represents the sellers failing, as evidenced by the wick that they tried to go down and failed. And it also represents where buyers overwhelmed the sellers and absorbed them to break the market out, to do a breakout above these areas. So this is why a pullback to test that area of resistance and near that absorption is why I'm selecting this turning point. So a couple of things to note. Market pulls back into that area, and now you want to take a look at it. It's very, very lucrative area to take a look at. By the way, market's going to pull back to that area too. So again, very lucrative to take a look at as this market is pulling back. What are the key behaviors? I believe it's setting up a pullback opportunity. But anyway, that'll be a trade for next week. So this is what I want to take a look at right here to see what is going on in this turning point, and you're going to see how I how I identify the turn. All right. So from a wave perspective, all right, I'm going to do this really methodically. So the market is going down, down, down. As it's pulling back on a higher time frame, it creates a trend on a lower time frame. A pullback on a higher time frame looks like a trend on a smaller time frame. The same is the case with a higher brick size and a smaller brick size. So it's pulling back, which looks like a trend. So now let's start analyzing it. Now, in my prior video, I showed the anatomy of a turning point, like a little model that shows the left-hand side, the separator, and the right-hand side. You're going to see those behaviors. So on the left-hand side, what do we notice from low to low? That the thrusts are shortening. From this low to this low, it's like a little spring. From this low to this low, it's like another little spring. From low to low to low, the thrust is shortening. So we indicate that. You have a shortening of the thrust. What else do you see? You see that as the market is going lower, there's a lot of volume in these two up waves, like 497. I don't know what else, but this was bigger than 1, 2, 3, 4, 5, 6, 7. These two up waves have a lot of volume. That's just the point. But in any case, shortening of the thrust and a spring. So what does the shortening of the thrust do? It is indicating that the markets are getting exhausted. And if you look at any indicator you want, like RSI or whatever, I guarantee you there's going to be a divergence here. Guaranteed. There's going to be a divergence right here. Anyway, so we have indication of a shortening of the thrust, but shortening of the thrust by itself means nothing. All right, because you have a shortening of the thrust here, your shortened thrust is shortening here, it means nothing. It needs to be, the turn is a sequence. It's the left-hand side and a separator and a right-hand side. You cannot take individual behaviors by themselves. It's like looking at a spring or an upthrust. If all you're doing is drawing the lines at support and resistance and seeing if there's a dip, that is not enough. It could be a lower low. That spring can represent a probe to go lower. It could be a low low. Similarly, in a turning point, you have left-hand side, a separator, and right-hand side. All those three categories, the behaviors in all those three categories need to be there in order for a turn to occur. So from a left-hand side perspective, we're looking at a shortening of the thrust. Is that there? Yes, it is. What does that indicate? The market up getting exhausted. How is it confirmed? Only when there is a sign of strength. All right, because it means that the exhaustion is leading to buying. Exhaustion on the downside, the bears being exhausted, is is uh, is being followed up by heavy buying. All right. So one side gets exhausted, the other side takes advantage of that exhaustion and starts buying. So here we have clear SOT. That's an indication of exhaustion. We also have a spring with the same thing. All right. But I wanted to call this spring out because there's something really important about it. I'll explain that. All right, so now I'm looking for the separator, but before I do that, there are other key behaviors. Look at these dots. This volume is the biggest volume in over 100 bricks. Obviously, something's going on. This is volume off the bottom. How do you know it's volume off the bottom? Again, you don't know it until the market goes higher. It could be short covering, or it could be something else. I don't know. It could be anything. So the key is, if there's a volume off the bottom, there needs to be a change of behavior. If there's a shortening of the thrust, there needs to be a change of behavior. Any bullish one bar indication doesn't mean anything until a wave helps confirm it. So on the left-hand side, you have a shortening of the thrust, you have volume off the bottom, and you have a spring, indicating that yes, there's exhaustion and there's buying off the lows. Now we'll take a look at the separator, which is, oh yeah, one more thing. There's cause. How do you know there's cause? They go high, low, high, low. So just mark this. It creates this resistance, up, down, right? So down, up, down, spring. Why I mentioned the spring and not just the shortening of the thrust was because as it did a spring, buyers came in. As it did a spring, buyers came in. Look at this print. So they're defending the lows. In other words, this is a rejection to go down because of the heavy buying that emerged from that area. It's rejecting to go down. All right, so now we're done with the left-hand side, and we're going to take a look at the separator, which obviously is your sign of strength, and that we're on that side now. Now, I mentioned that a sign of strength basically has the very big wave. It's like the biggest wave in whatever number of waves. That's how you know it's a sign of strength. Now, does that mean that any big wave is a sign of strength? No. It needs to have that left-hand side to help validate that it's a sign of strength. And it needs a right-hand side. The left-hand side and the right-hand side are both validating the sign of strength. So COB is the same thing as sign of strength. Right? I don't know what people call sign of strength, change of behavior, change of character, coach. I don't know what, but here's the point. From this high to this low, which is the biggest wave? The answer is the sign of strength. And by biggest wave, I mean biggest up wave. Here, this wave lasted 6 bricks, which is bigger than 3 bricks. Bigger than 3 bricks, bigger than 2 bricks, 1 brick, 4 brick, 3 brick, 1 brick, 1 brick, 1 brick, 2 brick. All of this. So this wave is the biggest in 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. It's a big wave. So this has the potential of being your sign of strength. Okay? Because the distance in the wave is the biggest. Now, the next step. When you're looking at a sign of strength, I've explained this, you need to have a breakout. If it doesn't have a breakout, the probabilities don't favor you. It could be something weird. Because buying and selling occurs on any time frame for any number of reasons. It could be just to do a stop run. It could be to mitigate orders that are higher up, like right here. You had this 23, then you had this big wave, right? So this big wave is mitigating these orders right here, or you say testing or whatever, right? So this is mitigating that. This is not mitigating shit, all right? So what we know is that this is a breakout. This is your sign of strength. This is your change of character. Where is the breakout? The breakout is right there. How do I know it's a breakout? Just take a look at the 2 highs before it. These are the 2 highs, and it breaks on increasing volume the resistance, right? All right, now we have that change of behavior, the sign of strength with the breakout. What is the next step? First of all, you have to understand within a turning point model of the left-hand side and the separator, which is this sign of strength, we are now on the right-hand side. On the right-hand side, you must have a lack of supply or lack of demand. Over here, obviously, it's bullish, so we need to see a lack of supply. So the pullback has to be weak. And how do you determine that it's weak? You determine that the pullbacks are weak based on two factors. Actually, any three factors: price, time, and volume. So from a price perspective, it has to be a 1 or a 2. From a volume perspective, it has to have very low volume, very low. And from a time perspective, it has to be very few number of minutes. So from a price perspective, you have your 1 here. You have like 2 here. And these are less than the 1, 2, at least three prior down waves. So these indicate weakness. The 1 here is less than 2, 4, 3, 5, 2, 5, 2, 2, 7, 3, 7. This is the smallest wave in 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 down waves. And if you're losing the 2, it's less than 1, 2, 3 waves. Okay. Now, if you're using volume to judge the weakness, take a look at the red. Look at how low this is. 126 contracts, which is less than 384, 566, 163, and all of this. So there's no selling pressure. So in terms of volume, there's no selling pressure. In terms of price, there's no selling pressure. This qualifies for sure as your what? Lack of demand, lack of supply. Are we done yet? No, because you're on the right-hand side, but you need one final confirmation. That confirmation comes in the form of a higher high, and there you go. The market now is in markup. You have left the accumulation and you're going into markup. It has left the accumulation stage and it is legit. It is in markup. What I'm explaining here is the distinction between how a market on any time frame goes from accumulation into markup and the key behaviors that separate it from going from accumulation into markup. The model that I devised was built off of a turning point where in the pivot you have accumulation, and on the right hand side, let me explain this a little better. Let's say you have a turning point right here and then goes up here. What folks don't realize is that this going down to this going up, this up leg is marking up. The left-hand side is marking down. So what do you think happens right in the turn? In this turn, you have accumulation. Sometimes you have reaccumulation, obviously on like a smaller scale, which is what's happening right here. Right? So here you have markdown. And yes, someone will say, oh, this is not marked down because it's not a trend. If you go to any lower time frame, a swing is the same as a trend on a lower time frame. So you see that everywhere. All right. So mark down, and here you have mark up on the right hand side. What is going on in the middle of mark down and markup? If you said accumulation, you're right. Accumulation happens right in this point in that pivot, right there, right in there. And the market continues to do this accumulation and distribution, right? At these lows and highs, the market accumulates and distributes and accumulates and distributes and accumulates and distributes. At each one of these pivots, at each one of these turning points, on the low you have accumulation, on the high you have distribution, on the low you have accumulation, on the high you have distribution, on the low you have accumulation, on the high you have distribution. This is what's going on. Now, yes, you also have a situation where you have like a box, right? And that box yields markup, and you're saying this is an accumulation box. But isn't that what I'm showing you right here? Am I not showing you the box that you learned in classical Wyckoff? Is this not exactly classical Wyckoff, where I show you cause within the box, I show you a spring within the box, I show you a sign of strength within the box, I show you the lack of demand, or lack of supply within the box. It's all there. Now, here's the thing. Not every time that you will have all the behaviors. For example, when the market is marking down, you will not have a very strong selling climax indicating exhaustion to then have like the secondary test and all of that. Sometimes you have a selling climax, and in other times you have a shortening of the thrust. And then you might have both. Okay, you might have both. All right, that's what happens. Sometimes you have selling climax, sometimes you have shortening of the thrust, and sometimes you have both, where you have a lot of selling, but the thrust is small. Why is that? Because those big waves that have a small amount, that have a shortening of the thrust, are being used to establish long positions. I'm not going to talk about that now. When I have an example, I'll explain that. But the idea here is you have markdown, accumulation, markup, distribution, markdown, accumulation, markup, distribution, markdown. And yes, you could call it reaccumulation and profit taking and reaccumulation, or just buying and selling, right, at these pivots. The thing is that accumulation or that distribution has key characteristics. These key characteristics of accumulation into markup, this is what, as a Wyckofian, you have an edge, because this is what we know. We know that about shortening of the thrust and the climax. We know that creates the left-hand side, followed by a secondary test. We know about the sign of strength. We know about the springs. We know about the volume off the bottom. What is this? This volume off the bottom, right here. We know that volume off the bottom triggers the sign of strength, either on the same wave or almost right after it, right? We know about cause. So that model, I'm applying it, and I'm applying it to show the accumulation on the pullback on a higher time frame to a level. This is that pivot. This is that pivot that I'm just explaining, that goes down, that goes up, and within that 5, you have all of this behavior, which represents I should call it reaccumulation, because actually it's really reaccumulation. Right? That's what this is right here. Here you have accumulation and the end of accumulation in the form of a springboard. Right? Yeah. This is the end of accumulation in the form of a springboard. This is reaccumulation. And on a lower time frame, it looks like that, where the springboard is actually a spring. So, I mean, before markup, sometimes you have springs and sometimes you have springboards. And I'll explain that also in future videos. But here you go. That is what you want to see. And I've explained accumulation as the market is pulling back to a level, the key behaviors that you want to see in the accumulation or reaccumulation, because once you have reaccumulation, what happens? Markup, or in this case, a swing, the next rally, right? Because reaccumulation will lead to the next rally. On a lower time frame, that rally is actually an uptrend, and you could call it like this all markup. So markup. All right, folks. Hope you found that helpful. This is the Wyckoff that Wyckoff talked about. So take care. Bye.